Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Thursday morning pre-market webcast. Okay, daily chart, then we'll hop on a shorter term time frame. So, I wasn't too busy on Twitter and everywhere else yesterday because we were going full on in the room, especially in the afternoon. But here's the breakdown of what happened. You had the 2273 high on the reaction off of jobs. They couldn't take it out. They basically did a double top or a slightly lower high at 72.5. It broke through the FOMC price area of 67.68, and at that point it opened up the 47 area that I had put up on the chart for you guys yesterday morning, which had been Monday and Tuesday support. We went down and we traded to that area. We traded below it. We traded as low as 43. So here's your lower high on the FOMC reaction. Set up a great looking short. Came down. We did 43. Now the key was, could they hold it? Could they hold this area as resistance? We figured it was going to trade to it. There were two issues. When it traded to it, was it going to bounce off of it? If it traded below it, was it going to hold it as resistance? Didn't bounce off it, which is good news for the bears. The bad news was they couldn't hold it as resistance. Once they failed to do that, they rallied it back up to the 57 area, which is also very important, and they closed it at around 52. What we've seen in the overnight is a move back up into that 57 area. You've seen that hold right around 6 o'clock this morning, and now we're getting a push back into the area of 50. Unless we get some real velocity, some real conviction from 43 to 47, this will set up as a higher low. The bears have their best opportunity at follow through that they've had in some time today. If they can follow through, if they can close below 47, if they can make a lower low, it will end the upper band ride and put a lot of pressure on the bulls. It will also open up the weekly pivot at 22.28 for a late week test of the weekly pivot. This is significant because it's a break in the pattern that we've seen, the price pattern that we've seen over the last few weeks. The price pattern of the last few weeks has been deal with the weekly pivot early in the week, establish it as support, and then build off of it going forward. To go down and test the weekly pivot late at least gives the bulls the opportunity over the next couple of days to potentially break the weekly pivot and close below it. What you will certainly see next week is you will see a weekly pivot above where it is now. Right now it's at 22.28. The price dynamic that sets up then is if you're at the weekly pivot or below the weekly pivot and you close there, the weekly pivot then sets up above price. Okay. By the weekly pivot setting up above price, it gives the bears the opportunity to then allow the bulls to trade up to the weekly pivot, bump its head, establish it as resistance. That's how multi-day pullbacks happen. Okay, that would open up the daily mid-band. And that's a more effective way of pulling back the market than doing some gigantic gap down that bounces off the daily mid-band on Sunday night, which is what happened 2 Sunday nights ago, which is what got the bears into trouble originally. So I'll be very interested to see the next 2 days and how that dynamic plays out. What do the bulls want to do? They want to hold 47. They want to get above 57. They want to go challenge those highs. If they're going to keep the band ride, they've got to make new highs. So if you look here at the daily chart, here, upper band's at about 70 and change. Now we have been trading straight down from 57 into the 49s for the last 30 to 45 minutes or so. You've got the 9-day simple moving average here. If the bears pull back this week, 9-day simple moving average most likely to hold it in. I still believe that. That combined with the 47. Right now, the 9 days at 41. If they can get through that, it opens up weekly pivot. The mid band's up here at 16. If the bulls want to keep the band ride, they're going to have to trade back up to the 73s. Trading up to 70 won't get it done because the bands will expand and they'll run away. It's doable. It's absolutely doable. It's going to take some work, obviously, but it's doable. I mean, it's hard to rule out anything on the upside because of the bears' inability to get squeezed if they lose a couple of attempts at making a lower high. So that's where we stand. Everybody have a fantastic day. Just really briefly, I've been talking about bonds and gold with our members. If you're someone who trades that stuff, take the 9-day simple moving average, slap it on a daily chart, and you can see what we've been using for the people that do that who are subscribers to sell bonds. The 9-day simple moving average has been a fantastic risk marker in both ZB and gold for the last 2 or 3 weeks or so. Okay, everybody have a fantastic day. Follow us over at Twitter at Princetontrader. Come check out the website, Princetontrader.com. Come check out the chat room. Come trade this stuff with us. We would love to meet you. If you do this stuff every day, I think that we're the place to be. And if you come check us out, I think you'll like what you see. Everybody have a great day. I'll be back tomorrow morning with another webcast. Trade them well.